Behind the China crash, how China makes money. Now, I'm not actually going to introduce this very much. I'm going to leave these guys to do some of the introduction, and I'm just going to ask them searching questions. But Evan, I'm going to throw it to you first. Tell us about, I mean, you've done a load of research over the last several months, more than months, years, right? On China and how your understanding of the Chinese economic model, what it is, and fundamentally how it functions. Obviously, it's an opaque system to everybody, however much of an expert you are, and perhaps even to the Chinese themselves, one sometimes thinks. But go ahead, tell us.
Yeah, I'll just do a brief introduction. So Invent IP is one of the branches of the Strategic News Service, and we've been working on this problem for a long time. And I was brought in about a year ago to do a specific research project. That's currently pre-released, so there are some things that I won't delve into. I'm sorry, I wish I could. But broadly, we can talk about certain things that I think are quite indicative of the rest of the model, and also a huge part of it. So I would start with banking, because it's so critical to any economy. And we're used to, in the West, looking at banks as being a certain way. They have certain regulations and whatnot. And the Chinese like to lead us to believe that a certain amount of the banks that are in the top 10, per se, usually about 6, are operating in exactly that way. And they only own 4, and then they have the central bank. And the other 6 top 10 banks, they're probably off doing real banking things, and they're not representing the government. They're very commercial. But we found that actually all 10 are representing the Chinese government. And what they're doing is they're serving as a funnel for government funds. And that means, whatever the CCP, the Communist Party of China, decides they want funded, those top 10 banks, which are, I think, the top 4 out of 5 banks in the world are some of those banks, they're all just funneling CCP-directed money to the right efforts. So it's very top-down controlled. It's not very commercial. And the next question becomes, where is that money coming from? And there's surely a large economy in China. There's a lot of foreign direct investment. There's real money coming in and out. But there's a lot of fake money coming in and out. And what you see with these banks is that money is often created almost out of thin air. So it's coming from the party, but how do they get it? How do they create the paper that says that there's value here? They use a couple different systems. They use local government financing vehicles, which, if you've ever heard of them, really kind of run the gamut of about anything that you can do to create a fraudulent value. A common use or a common method that is used by the Chinese government is to improperly assess property values. So we've all heard of the Olympic Stadium in a medium-sized city in China, and there's lots of them that will never host an Olympic Games. That could be valued at very high value for an Olympic stadium, but really it's just swampland with an empty building on it. And so you do that, you create this massive value, and you issue these municipal bonds, and half the time they're buying them themselves. So the same municipality, through a workaround, will buy their own bonds, and it just creates fake value, which you then use to invest through these banks.
Mark, dubious accountancy, it's not unique entirely to China, and we do know, we've known for a while, that the Chinese numbers are not always as, well, everybody has kind of priced that in, right, when they value the Chinese stock market, or they put value on American companies that have trade there. Why does this matter so much? Why is your research so significant?
There was a moment that when we were doing this work, it was just as Evan was getting started, when I had this light bulb experience. And I had been thinking that, and the way that Evan was describing it, it's like, here's just one more country. We've looked at Japan, we've looked at South. Here's one more country, and if you just apply the same kind of tools and metrics, you'll get the same answers. It's a big world out there. It's a globalized world. People think that way. They think it's a globalized world. Everything's the same, basically. And the light bulb moment was, no, it's not. Here's a country which is radically different. We're kind of used to the idea of Russia being different in its own way, but I don't think people understand China in the terms of its business model. And the banking system of China was kind of the centerpiece of this light bulb moment. And I realized that these weren't banks. The banks in China are not banks, by any definition you'd use in New York City or London.
They're an extension of the central bank.
They aren't even, yes, they are, but it's worse than that, because they put out accounting reports, you can read them. But what they really do is they're just this, picture a gigantic pipe. And stuff is poured in the top and it comes right out the bottom. That's all that they are. They're a distribution scheme for political ends. And when normally you'd say, well, then they would go bankrupt. They can't go bankrupt because there's no backing up of bad loans. So what happens to bad loans? And I think actually Evan's an expert on this. I'll turn this over to him. But the fact is they do not back up. And so you've just got this gigantic chute of stuff. And that's the bank. That's the top 10 banks in China. And that's the centerpiece of the entire economy. So, I think I'll turn this back to you.
So that's the model. It's a kind of Ponzi scheme.
Yeah, you could describe it as similar to that. That's more, that has emotional connotations that I would try to avoid. But yeah,
Sure.
there's a scheme going on.
And what is the consequence of that? I mean, are we therefore sitting here predicting some enormous kind of pre-Lehman's moment that we've
Well, the
got?
fascinating part, if you look at the banking system, is that the buck has to stop when you're behaving like that. But as you were saying, there's a lot of ways that they sweep these bad loans under the rug. So they use asset management companies. Those aren't unheard of. Sweden actually used a similar scheme when they had a bunch of bad debt. But this is on a scale kind of previously unknown to man. And it started in the late 90s when they had a whole bunch of bad loans in China. All these major government banks put out an incredible amount of bad debt. And they realized, no one's going to invest in this country if they realize what's going on. We've got over $1 trillion in bad debt. And they put them in these AMCs. And normally, you then spend the next 10 years fixing that bad debt discreetly, quietly, in a different holding company. But as far as anyone can tell, these holding companies are still insolvent. And not only are they still insolvent, but they've just been putting more and more bad debt in ever since the late 90s. So it just builds and builds. And there have been a lot of different schemes that have been used to try to work it around, hide it, take it off the books before the end of the fourth quarter, all these things. But it's got to stop somewhere. And part of what you see is that there's this building sense of doom. And just because the wall, the dam hasn't broken doesn't mean it's not about to. And the question is, how long can you keep it up? So we could switch to markets too, because that's what we're partly here to talk about, was the crash. And it's important to distinguish between equity markets and the economy itself. But in China, they're related via the Standing Committee, right? So the Standing Committee is aware of the economy and the problems in the economy. And what we saw over the last year is that there's kind of a pattern where at the beginning of this year, you could tell there was a bit of a pickup in the Standing Committee of bad news. Something's going a little bit wrong. And it's like, okay, here we go. We're not going to make our GDP figures. And we already know those are completely off. The public numbers are off. But they're likely much drastically lower than even the Chinese are saying. Even if they're lowering the figures, it could even be negative now. So, what are they doing? They're going, uh-oh, here we go. They get bad news, and they start to kind of goose the economy. They start to try to encourage a lot of investment in the equity markets.
Private investment, right? Ordinary citizens investment.
Yeah, and it goes from the casual pushing of it as we are doing really well, the market's going to explode, everyone should get in, and you see that rise that China saw until midsummer, essentially. That was more casual at first, and then you hit that point where suddenly the buck stops. Somebody notices bad value, they get that dip, and then international investors start to get scared. And then the Standing Committee starts to panic, and they start doing those more heavy-handed interventions that we saw during the crash over the summer.
Sure, and there was a huge amount of credit that went into that bubble that burst in July, right? But Mark, I mean, everybody said around that time, the stock market crashes. There's something different about the Chinese stock market. It's the rest of the global economy isn't fed into that. We don't need to worry quite so much about that as we would if it were Tokyo or Frankfurt or somewhere. So I mean, how worried should we be by what we saw over the summer?
So the reason this one is different from Mexico or us, or I'm sure everybody points to us and says we had a big problem, the West did, is that the system is different that it came from. So I think you have to go back. Evan's just done a good job of looking at the equity markets, but you have to go back to the actual economy. And if this is going to face catastrophic failure, if there's a real collapse available here somewhere in the future because of the way the banking system has been managed or because of the way these other things are being done, then the equity markets are just kind of a symptom. They're just kind of a mirror. And it's not really about that. They're just our way of seeing into what's happening. The same thing with the poor people in China who've invested and lost all their money. But the real story is the economic story, the domestic economy. And the call that we made, I think it was May 25th was the first time, was saying investors in the world take a notice, because it's not going to be a worry about the equity markets. It's going to be a worry about the domestic economy that's going to bring this equity market down. And that's different. You know, most markets have their own lifestyles, basically. They're kind of off here, and the real economy is over here someplace. But in this case, they're in step. And so when we saw the equity markets all over the world start going down in recognition of the fear of this might be happening, right? It was because they were worried about the domestic economy. And we made that second call in July for that exact reason.
So how bad are we talking about? Okay, everyone adjusted. We were told 7% GDP growth, and everyone said, okay, that's nonsense. We know that's nonsense. But most of the estimates vary between, 3 and 5 GDP growth for China, which is bad compared to what we knew before, but it's not the end of the world.
Well, if it's collapsing, it's not a positive number.
You think it's negative? So you're saying China is in recession right now?
Yes. When Evan was talking about the debt, there are some people, I don't know if we're there yet, who think that China's already broke. They have all this. You always read about the reserves, but you don't ever read about the actual debt number. And it could be a wash. And then you kind of look at any system that's been propped up from top down, 7 people at the standing committee putting fingers in dikes all day long. That's very effective. They're very smart guys, but at some point it's going to break down. The piper, as Evan said, the piper's going to get paid here. So what that does by postponing that market, the real markets, which we all thought were in play, by postponing that justice, what happens is when it does go down, it goes down heavy. There's a real crash instead of a bad few days or something. So this is really a different kind of problem than the big crash we had in 2007.
Bigger than that?
Well, it's different than that. That was a global problem of bad banking behavior, derivatives and all that, caused, I think, by global liquidity. So it was truly a global problem. But this problem is a Chinese problem. And so the exposure to China is one of the big questions you want to ask, whether you're an investor or whether you're a trader. The more exposed you are as this happens, the worse it will be for you. But it isn't global the way that 2007 was.
Evan, we're in the business of predicting very quickly. Speculate for us, if you will. What would trigger this collapse now? I mean, I thought property prices had flattened out in China. That was the bubble that we were all feared of a couple of years ago, and that seems to have sort of flattened out. Is there something else that's going to cause this house of cards to collapse?
Well, I think property prices is a good place to start because that can easily cause a collapse and because it has caused flips. So I would keep an eye on that because I think it's still incredibly inflated. When you look at the Chinese economy, that's one of the biggest things that comes up. But I think this banking thing is really important. I think it's important to keep a very intent focus on the banking system because of what I was saying, because there's still so much bad debt. It's almost become a multi-generational bad debt problem. So when these AMCs that still exist, that are insolvent, and that may equal all of the rest of the reserves in China, that may make this all a wash, as Mark was saying, when they stop functioning, when they run out of ideas, and like you were saying, these are very smart guys, so there are a lot of ways to sweep this under the rug. But anything that happens with those AMCs, and they're not often talked about, we should be focusing on, because that will lead to a serious crash in the economy, which will affect the equity market.
Questions, please.
Ed, we
go
saw,
to the mics, but go ahead.
Yeah, we saw some of these leading indicators, which is how we made the calls, right? And one of them was, a very important construction company in China that clearly was allied with the party, had everybody on their side, went bankrupt overnight. It would be like saying Bechtel went bankrupt overnight. It's not going to happen. And so what was being done? How many fingers were in dikes until that moment? That when we suddenly had a catastrophic collapse of like the second largest construction company in China, and they pulled out the guy who was the CEO, and then a few weeks ago, you figure the party's going to fix it, inject $1 trillion, whatever they got to do, right? And then they put the guy back. The same guy, he's back in, a month later he's back. And if this isn't a leading indicator of things that are really, really, really out of step and wrong and not stable, there is no such thing.
Well, that sounds just like political dysfunction, doesn't it? I mean, not necessarily economic.
Well, they're the same thing. That's the difficulty we have that we're trying to describe. In New York or London, it would be two different things. But it's exactly the same people and the same thing. When you say the second largest construction company, you're talking about the CCP. It is the same thing. I mean, literally, you couldn't run that company without their kind of daily permission.
You have a question, sir?
Yeah, so just exactly what you're saying about the same thing in the cybersecurity world. The analogy I use is, we try to protect our companies, and then we try to protect our country, and those are separate things, and we try to protect our military. But when the Chinese do things, the government and the military and commerce work together as a single entity. And I think most people in the Western world don't think about that as a fundamental difference. And so it's, you know, I know you guys have done a lot of thinking. I mean, so when this house of cards comes down, you know, how does that affect us? I mean, you can think about, I mean, obviously the worst case scenario is World War III, right? But short of that, I mean, what kind of effects do you see on us and the rest of the Western world when this comes crashing down?
Yeah, that's a really good question and something we think about a lot. And that's part of why we're here speaking, is that when you see that kind of problem, and we saw a hint of it, it does affect the equity markets. And when you affect the Chinese equity markets, as much as we would like to believe this doesn't happen, there are ripples across the world. And we're so tied in. Actually, you wrote a really great SNS piece that showed, it was the China short, if anyone read it, sorry. And it showed the effects in other economies when China takes a hit. And I mean, for instance, Brazil tied their wagon very closely to China, and they took a huge hit in their GDP. But in the equity markets too, we saw up to, I think, a 10% drop in the S&P 500. And that was, you know, with a week delay or so at the end of this last summer. And that was the effect of China taking a hit in their equity market. And that was the effect of the CCP playing around trying to fix their domestic economy.
Quick, I'm going to try and be a little bit adversarial here. I've spoken to senior banking officials like HSBC and other places, and they say, look at the fundamentals. China has still got an incredibly educated workforce. There's a massive population. Okay, their wages have gone up a lot, but they are still a very productive economy, whether it's based on IP theft or anything else. They're still producing a lot of stuff, and there is such a ground basis for a strong economy that even if there is a blip, even if there are some bankruptcies, and the government is allegedly, we're told, trying to slightly deregulate, take its hand off the tiller a little bit and allow things to free flow fractionally, it'll be a downward swing, but it's not going to be a downward crash.
Are you quoting the Hong Kong Shanghai Banking Company by any chance?
You're quite right. That is the name of the corporation. Yeah.
Who just moved their headquarters? Never mind.
Well, I think there are a couple of things to be said to that, aside from the fact that that is kind of the party line when things go wrong in China. That's what the government puts out, which is, look, even if there are issues, we're doing all right. Part of the problem, the first problem, would be, what are the fundamentals? And if we don't know them, then how am I going to look at your fundamentals? Two, I think that when you look at what they're saying, it's, yeah, of course you have a strong economy, but that's the point of the work that we're doing. How strong and how much of it is real? And so maybe your fundamentals, if you followed, what we did too was look at an average of other really rapidly advancing Asian nations, and of course China's different, but if you look at the fastest growing Asian nations, how are you doubling or even tripling some of their GDP growth rates? What is that? What is your special sauce? Because it's not just cheap labor. So there's something going on there. And what we're looking at is it, a large part fake? And it's not going to be a tiny blip. I mean, what we just saw over the summer was part of a whole. So we know that it's not nothing. It's not small. It's quite a large economic problem that they're dealing with. So I don't know. I think it kind of speaks for itself if you just avoid seeing their party line too much.
But Mark, I mean, crises happen when everybody panics. Is the central kind of Communist Party in Beijing going to do a good enough job to at least allow us only to kind of 50% panic, or just get a little bit anxious and sort of, in other words, slide down, just lower our expectations in a gradual way, which would, let's face it, in itself help to preserve the global economy?
I think what you just said is true for free market economies, not for China. So when panic occurs in New York or in London, you're absolutely right. That's how it works. That's the mechanics of a crash. When you have complete control of the news, when you're arresting reporters who tell the truth about the economy, which just happened in China, when you have complete control of the markets because you tell people they can't trade anymore, and you start forcing them to buy, even though they don't want to buy, when the government becomes a buyer and comes in at 2 o'clock every day and buys stocks to keep the thing looking good, that's a different story. That's a different world. That's a different universe economically. And so if the question is, what does a crash look like in a top-down government like that? I don't think we know. But I don't think it's quite the way you described it. It's not going to be a gentle glide, I don't think. It would be more like an internal explosion when the news didn't get out. You know, it's a picture of a nuclear bomb, but no one was there to hear it, right? So it's not that there's no damage done, but the damage will be controlled and the news will be controlled. And so what we'll hear and how long it'll take for that blast wave to get out, I don't think anybody knows. But is there a blast wave? Yeah, there is.
One more question, sir.
Yeah, I would like to address a question about what you said was the Chinese problem and the risks that companies face. As a Thunderbird student, I was able to participate in a class overseas in Shanghai, China, with Professor Teagarden out of Thunderbird University, Thunderbird School. And one of the things that we came away with was companies are being told that if they want to be leaders, that they need to be in China, that if they're not already there, then it's too late really for them to be leaders in the market. So I'm just wondering how companies are going to face this decision if they're being told on one end, they need to be in the market, and on the other end, we're saying that the more they're exposed, the more risk they face. How are they going to make that decision?
Well, it's a risk calculation, and the risk calculation just changed. So you know, they always say it's greed and fear drive these decisions, right? And that's the risk calculation. I think that the calculation changed already, say about 4 or 5 years ago. Initially, the thought was pure greed. I'll give away everything that you want me to give away just to have access to all those tennis shoes I want to sell over there. And that was literally the thinking, the level of thinking. And then about 4 or 5 years ago, it feels to me as though, and I think this is true at the American Chamber of Commerce, it changed. And people had been damaged enough by other practices that it wasn't fun anymore. And you started asking, well, who's actually making a profit? A profit? We tried to count. It was like 5 companies. You probably got 5,000 companies over there, but how many law firms? It was like no law firms were making a profit. This is interesting. So as that sunk in, the risk calculation changed, I think. And I think with the internal collapse that we're trying to describe now, people who are CEOs of major global companies are going to make a new calculation because the greed part's going to go down a bit. And the deeper worry is watching the government of China push out even harder on tech companies, particularly. So we saw that starting with you can't be in any finance stuff, remember that? And then suddenly it was like, guess what, we have a new law, you just can't anything. It's kind of a poker game, you know, but maybe we'll let you one guy in. And so Mark Zuckerberg asked Xi if he would name his unborn child. I was like, come on, this is a true story. So I think, you know, the government is reacting by arresting more people, clamping down on the news and in a lot of ways, and pushing companies out at the same time that these companies are trying to make this fear, greed, risk calculation. So it's a tougher calculation, that's for sure.
Can I just ask, we're going to stop now, but just in 1, 2, 3 sentences, Mark, I'm going to throw it to you. You are Mr. Predictor. We need a number for 3, 5 years from now. I mean, what is your anticipation? If people are making commercial calculations in this room right now thinking, what do I think about what China is going to be in 5 years from now?
Okay, so I think on January 1st, the Standing Committee got the news. I think somewhere around May 1st, they had their, I'll say this politely, their bad day, you know. And somebody said something to somebody at that level. It's like, we are now in collapse. That's what I think happened privately.
So it's already happened?
Yeah. And then, or we're facing collapse now. We're run out of tools on this one. And then let's take the nuclear thing back as a metaphor. Assuming that the collapse is underway now, when will the world hear about it, really? We kind of heard about it last 2 weeks or 3 weeks. So let's say we hear about it by, certainly within 12 months. And after that, it's anybody's game. So it'll be a fight between controlling the news, manipulating the markets, arresting people who get out of line trying to talk about it, and the rest of the world radar up trying to figure out how bad is this after all. I think it'll be quite bad. So I'd rather have the news get digested in the West or the rest of the world so that we can kind of deal with it and write it off than to have this trickle out thing that's probably going to happen.
Tin hats on, everyone. We're done here. Thank you very much.